Hi, this is Paul Carlson, CPA. In this video, we're looking at a financial model for a startup engineering firm. So we're going to first quickly run through each of the pages within this model. Two, we're going to talk about why this complicated model is so valuable to an engineering firm. And then three, we'll walk through several of the lines on each page of the report. So to start, the report is 6 pages long. So we start with the balance sheet, which is interpreted as everything that the firm owns at the top and everything, the money that it owes to people at the bottom. Next 2 pages are the statement of operations or the income statement, just 2 pages long with all the detail. Third, we have a cash flow forecast. This is a full official GAAP statement of cash flows. And the key benefit or the key item in this report is it shows us the amount we should have in the checking account at the end of each month. Keep cruising along. This is a supporting schedule page where we are modeling payroll per person. That a lot of times payroll can be very ambiguous, where here we forecast payroll by person. And then the final page is some input values where we are forecasting time charges on an individual employee basis, and at the bottom we're calculating billed and unbilled revenue. So let's cruise up to the income statement and talk about why this is so valuable. So this model is done on a full GAAP or accrual basis because that provides a very clear picture of the actual financial performance of the company each month. So a couple examples. In July, we are recognizing $6,600 worth of revenue, and that's a combination of we plan to bill clients for $5,200, and we're going to have time charges for another $1,300 that will go into work in progress at month end. That is, will be billed to the client in the following month. Some firms are just not able to bill all of their time at the end of every month, depending on the projects. Other more simplistic accounting tools will at best recognize only the billed revenue piece, and it completely ignores unbilled revenue, and that would be QuickBooks standard accrual basis accounting. That QuickBooks has no concept of picking up unbilled revenue, and it does not track work in progress over time, which is a significant portion of engineering firms. Another example of accrual accounting is liability insurance. For this firm, we're estimating they're going to have to pay $4,800 for the first year, and that has to be paid up front because if you pay insurance over time, they charge you 20% interest. It's just silly. So here we're going to prepay the full $4,800, and we're going to expense $400 for each month. So we have a clear connection of we're assigning that monthly usage to each month. And with that type of reporting, we get a very clear picture of exactly how the company is doing, and we have a very clear picture of how much cash will be in the bank at the end of every month. So if this type of reporting and modeling is so useful, why don't all firms do it? So first, to run the strong accounting is you need a good accounting system. So in the budget, we are brainstorming that this firm would go ahead and subscribe to Agera as their accounting system. It's an accounting project management system specific to A&E firms, and it can do the full accrual basis accounting. A lot of firms postpone purchasing a real accounting system until way too late, and they have to kind of make do with other accounting systems that just omit such big pieces. The other aspect that's difficult is this is done from a dedicated financial modeling tool, that there's very few tools where you can forecast the balance sheet and the income statement, and the tool will calculate the cash flow forecast and allow you to have supporting schedules to feed in and document the assumptions to the forecast. A lot of times you start doing this in Excel, and Excel spreadsheets are always wrong when it comes to doing financial models. And doing a cash flow forecast that's running receivables and owner notes and credit cards is extremely difficult to get this correct, that most people just don't even try. And then third, you need a controller who knows the industry and knows how to make the accounting systems and the financial models dance. That finding all three of those pieces in the A&E industry is pretty rare. And that's where we come in and help firms. So with that in context, let's walk through each of the pages in the forecast. That actually this forecast is for a friend's startup firm, that the numbers are somewhat similar to what they're talking. And so I'm going to spend a few minutes so they can kind of understand what's going on with the firm. So this is the forecasted balance sheet. Balance sheets are always reported as of the last day of the month. So when we look at forecast July, what this really means to be read as the forecasted balance sheet as of July 31st. So ending cash is calculated by the financial model. Accounts receivable, this is the first month's billing that we're going to bill to clients on July 31st, August 2nd, and that's how much clients will owe to us. Work in progress is time charges that we went into the system that we were not able to bill in July, but we plan to bill it in August. Prepaid liability insurance is where we talked about that for liability insurance, you typically have to prepay the full year, and we amortize that over the years. You can see the balance goes down as we release the amount each month. Azure Cloud requires you to pay for the full subscription for the year up front. And so this shows the prepayment and then declining over time. The firm plans to spend $5,000 on computers up front, $5,000 on software, and we're going to start depreciating those assets right away. The firm will have a credit card, and we are probably going to put all that software and the computers on a credit card right away, which would give us the $10,000 credit card balance. And then over time, we'll pay down the credit card as it gets used. If the firm works from California, there's a minimum franchise tax that all firms have to pay, and so we're going to start accruing or saving up for that tax bill. To provide initial funding for the company, just eyeball estimates for this model, we're assuming that each of the two partners will contribute $30,000 cash to startup. And down here we're assuming that each person or each shareholder will contribute $100 towards stock. The attorney doing the legal documents will direct exactly how much stock needs to be purchased by each person. And retained earnings is the amount of net profit the firm has earned throughout the year. So in month one, we lose $15,000, and over the year, we have positive net income, so retained earnings goes positive. Let's switch over to the income statement. Most of these accounts are self-explanatory, so we won't go into quite such detail. So billed revenue, this is the amount of invoices that go out each month. Unbilled revenue is a cumulative amount of charges that we've added to the accounting system that have not been billed. See here, for this model, we're going to assume there's no write-offs in the first year. We're also not modeling subcontractors at this point. Typically it's a wash, and we want to get the basics down first before we make it more complicated. Notice the owners are not starting payroll until they get to October, so there's 3 months with no payroll. Payroll taxes start with payroll. Health insurance starts right away. As here, depreciation is we're releasing or we're expensing the computers and software over time. Expecting to pay some legal costs up front. Accounting costs, let's see here, not a whole much to explain there. The Azure install, we may need to hire an outside consultant to help provide training to both the engineers and to do some of the setup assistance. And from there, and here's the expense side of saving up for the California franchise tax. So with this, we can see that our net income for the first month is a $15,000 loss. And we have, we're starting to get to $20,000 net income pretty quickly throughout the year. The big drop from September to October is, remember, we start payroll in October, and so that's why net income decreases. it. Goes on down to the cash flow forecast. So honestly, most people need to look at this type of report for 6 months to a year in financial meetings with me before most of the lines start to make sense. Think of the numbers as changes of balance sheet values. So July, each of the two partners has to contribute $30,000 as startup funding, so we can see that that's a source of cash. We are going to borrow $10,000 on the credit card, which is a source of cash. And we're going to spend $10,000 on computers and software, which uses cash. So with all these variables, the software is providing an accurate ending cash balance at the end of each month. The key constraint for A&E types of firms is so much of the initial couple months of revenue goes into accounts receivable. So this firm goes from 0 to $80,000 in accounts receivable within the first 3 or 4 months. That is time that we have billed out to clients that we have not yet been paid, that we can't use that money to pay bills until clients actually pay us. And that is all accounted for in this ending cash forecast number. So we can see at the lowest point, we're forecasting the account will drop down to $18,000 of cash at the end of October. If the partners wanted to drop their initial contribution to $25,000 a piece, would make this down to $8,000, which is really tight if we're trying to avoid any sort of unpleasant surprises where owners would have to contribute additional cash during the startup phase. So again, just focus on the bottom line on this report because that is the forecast of cash. The piece that is not included on the model at this time is once cash levels reach what we're comfortable with keeping in the bank account, excess cash will first be used to pay back the advances from the directors. Once that $60,000 is paid back, then excess cash will go out to directors as distribution, the additional payments along with their monthly paychecks. So supporting schedules, this is the forecasted payroll for the 2 initial directors. Once we bring on associates, we will start modeling associate payroll as well. In the modeling software I use, if a row has a $0 amount, it doesn't print on the reports. So I'll put $1 in as a placeholder just to force it to appear on the reports. So when the new owners are looking at this, they can see exactly where we would start to model future payroll for associates. Within this report, we are trying to do 2 things. One is we're trying to forecast monthly time charges by employee, and then we're trying to calculate how much we're going to bill and how much will remain in unbilled every month. So in professional services, so much of the revenue is driven by the number of days in the month. So we can see we'd expect that with 23 billable days in August, revenue is going to be higher than in December with 20 billable days. A lot of times on these forecasts, we'll change December to be realistically 5 holidays as everyone disappears for the week between Christmas and New Year's. So what we have is the number of working days, a forecasted number of billable hours per day per director, and then we forecast the average billing rate. So in this total time charge calculation, it's the number of billing days times the average times the number of billable hours per day times the billing rate, which tells us in month 1 that the directors are going to provide $6,600 of billable time charges. In this model, I'm assuming that billable revenue will be 80% of that month's time charges, and the remaining 20% is billed in the subsequent month. And with that, we've walked through the detailed pages of a startup engineering firm Financial Forecast. If you have any questions, please give us a call. Paul Carlson, CPA. Thanks. Bye-bye.